Okay, so I've hit recording because you know what happens. You do a fantastic presentation and then only to realize at the end that you haven't been recording it. So the worst thing that can happen to you, right? So your cameras can remain switched off. Your microphone, I would appreciate if you can switch it on only at the end. So today's session will take about 45, 50 minutes. It's not like I've put a timer on there, but we can, the presentation will cover some important points and then everything is recorded. I'll send you the recording after that. Like I said, there are far more people that have subscribed to the webinar today, but you know how this is. Some people could not make it at the time. So we'll do some live examples and I will tell you why options are superior. And then I'll give it another minute. While I give that minute, as you can see, the participants, you got Isabel, AI components and to access topics and content from this video. You can change access permission to the AI. I haven't used that AI companion, but there you are. Technology, my best friend. For this power manager, catch me up when. Yeah. But I don't know what to click here, my friend. If you know, let me know. So hello, Isabella, I can see Jose, Carolis, Katy, Katya, Chris, Leona, Linda, Marianthi, Miropoulou. We got some Greek here as well, people. Thank you very much for joining. Phyllis, and hi, Rita. I guess Finnish or something like that. I hope I'm pronouncing things correctly. I do speak a few languages. Finnish is not one of them, but maybe in the schedule. Okay, thank you, Rita. Takis, yeah, I know Takis. You must be Greek, Takis. Tamana, Theo. Zimbabwe, wow. Well, thank you very much. Zimbabwe, I wouldn't expect people from Zimbabwe today. At least I haven't had people from Zimbabwe, which is nice to have. And okay, this AI companion, I'm not sure, my friend, how it is, but I'll send you the recording. So don't be lazy. Watch the recording. Hello from Brussels, Christos Vasilakos. What are you doing? You've left sunny Greece to go to the rainiest city in the world, literally. I thought London was raining a lot, but Brussels is raining a little bit more than London. So kudos for that courage of yours. And just writing me in the chat. Not now from Brussels, okay. They're like, who in his right mind would leave Greece for Brussels, right? Okay, so just so you know, I'm doing the seminar in English today, but I also do my seminars in Spanish and in Greek, okay? So if you are Greek or Spanish and would like to access this, Ivan Stoikov, yeah, I can tell Bulgarian, right? So hello, neighbor. So if Spanish or Greek is your language, make sure you reach out to me separately because, I think you would like to hear it in the same language. Not today's session, right? Today's is going to be in English, of course. It's not my avatar speaking, it's me. But, the seminars that will follow, perhaps you would like to include in your arsenal, and that's going to be in English. So let me just, so it's recording, sharing, and well, there you are. Okay, so I'm not going to bother or go into detail about who I am. I'll just remind you, today's session is all about you understanding how powerful options are. You've got an idea if you watched my webinar, because I guess you did. And I use my STAR strategy, which is essentially selling volatility. But today I'm not going to go into details. You don't need details like, jargon, because that will deter you from understanding how powerful options are. But today I would like to show why this product is indispensable, and comparing to stock holding, and then finish with something like an offer that I think you will appreciate. After all, you're here to learn. And just a few words about me again, before we move on. I'm Yannis Kandargis, I'm Greek, born in Canada. I've spent like decent part of my life in London, working for Citi and CMC markets, where I brought CFDs into Spanish, Latin American, and Greek markets like 25 or 23 years ago. And the rest of my life, I've spent it between Spain and Greece. And I've been running one of the Europe's most successful trading magazine. It's called Traders. So if we've got German people in here, you know, Traders magazine was the same magazine. I was doing it for the Greek and the Spanish language. Okay, I've stopped the Greek language, and I've only kept the Spanish magazine website at the moment. But you have access, if you ask me to, for first of all, the 20 best interviews. I've interviewed quite a few people who are like, you know, Bloomberg, CNBC people you see, like Mark Mobius, Jack Schwager, Linda Ratsky, Peter Brown, Joe Rose, Jack Schwager, yeah, I've said that, Peter Lynch. I mean, all of these great personalities, John Bollinger, including Rafael Campora, and the list goes on. I've interviewed them for my magazine. And then, you know, these 20 interviews are available in the Greek language only, and some of them in the Spanish language. And what I've done is, like, I've been trading and teaching options for the past 26 years of my life, pretty much my whole professional career. And I've been doing that in colleges as well, in Greece and abroad. So, you know, teaching is something that I really enjoy and find pride in it. And obviously, I've been trading and investing myself for as long as I can remember. I'm doing all that, playing piano, which I really like. And I also have 3 kids. And I'm telling you that because, you know, I teach and I trade, but the priority is, you know, kids for me and family, and spending time with them and listening to their problems and sharing their happiness. And that means I'm not staring at the screens 5 hours a day, and I'm watching the markets for like 30 minutes a day. And this is what I want to convey today. You can make money and overperform the market without, you know, sticking onto a screen. So I always I always show an example because, like I said, I have to admit people who are latecomers. So I always show an example with Apple. So say you have Apple stock here, right? So Apple stock, excuse my writing. Let me take my watch off. Like I said, it will be like 50 minutes, and then I'll take questions and answers, whatever you want to ask, right? So you've got Apple stock. I'm investing in the long term using stocks and ETFs, okay? And in the short term, I'm managing the volatility and the crazy stuff that either wars, inflation, Trump, or whatever else brings in the table, okay? So, you know, I trade stocks, or I invest in stocks, better said, and I hedge that risk using options. In my 30-minute video, I just mentioned, you know, what I learned at Citi, which is like when you buy something, you have to sell something. In that, well, the example I will show today, I'm going to cover 3 or 4 strategies and then give you a little bit nitty-gritty in terms of volatility. Okay, so if you own Apple stock and say you own 100 shares, okay, of Apple stock, that would be today worth what is it, 100 shares by $210 per share. So that will be $21,000, correct? Let me just do a little bit of this here. Okay, so you will need to put up $21,000 to buy the 100 shares of Apple. And I'm fine by that, yeah? I will just show you why it is always better to sell call options on those shares. As an example, it doesn't mean that you will always do that, irrespective of market volatility and status, but I will show you the superiority. So first with that, I would like to show you why owning shares of Apple and why just buying outright call options, which is the equivalent of an option that actually bets on the upside, okay? You don't need really to understand the whole jargon today. Just think that it's very easy. It's only 50 words. I'm not going to be able to cover them today. I just want you to grasp very well the idea of what it means to be on the 5% that you can always make money, allowing time for the market, right? And stop praying when you bought a stock that it goes up and having binary results. If you buy, stock goes up, you make money. Stock goes down, you lose money, okay? But the example here is to show you that if you got 21,000 invested and then Apple goes up by 10%, yeah, up 10%. Oh, this thing is not very stable. Then you make what? You make $2,100, correct? And so your return on investment is what? It's 10%, of course, right? So return on investment, how much money you made on the money you actually put. Now, why people love options, but for the wrong reason? Imagine you have a call option on Apple. Okay, a call option. So what is a call option? It's just an option. And when you buy it, well, actually, whether you buy or sell it, this option will rise when the stock rises and it will fall when the stock falls. So it follows the direction of the stock and it benefits from a stock moving upwards and it loses value from a stock moving downwards. Okay. So what a naive investor thinking that he knows everything, or like that, you know, you can learn options by going through the internet and reading a couple of articles and then thinking that I can trade and make money and so on. They will do. Now, before I tell you what they will do, I should tell you that on one option, yeah, is equal to 100 shares. That's how they made things. And apologies again for the handwriting, is even worse on the iPad, yeah, but I'm sure you can leave it. Is legible. So one option is equal to 100 shares. Okay, that's the way they've done it. So when you buy one option on Apple, it's like buying the right to acquire or sell 100 Apple shares, okay? And that's why they call it option, because when you buy an option, you get the right. Yeah, it's an option. And when you sell an option, by the way, it's an obligation. But I don't want you to think of all that. The beauty of options is that you can do many different things and still make money. And I will give an example with football because I'm sure you will understand it. So one option equals 100 shares. Say you buy one call option on Apple, one call, and then, you know, where did you buy Apple stock? $210. Well, the strike price, as we call it, will be $210. What's the strike price? So this is the price at which your call gets triggered, in other words, right? So you buy a call option at $210 Apple. That means that above $210 at expiration, and I will explain in a second, you will start making money. You can make money before expiration anytime. If Apple goes bananas, you still make money. But for the easiness of things, we just always mention graphs at expiration, okay? So you can replicate what we've done at Apple stock share, owning shares, you can replicate by just buying one call option. But this call option will be selling for like $3. It's not $3, it's actually, you will pay what? You will pay $300 because one option is equal to 100 shares, okay? So I will show you on the platform. I use Interactive Brokers platform. So they are present in the United States, in UK, and in Ireland for the European clients, okay? So you can buy a call option on Apple. $210 is the strike price, the price at which you have to set a price at which you can start winning or losing money. And that will cost you $3. So Apple goes up by 10%, right? So 10% on this position will be Apple going up from $210 and will be going up by $21, right? So now your position, you make $2,100. It's the same, right? Because the stock here and here has gone up by the same. Here, you make money because you've got 100 shares, but here you make money because you have 100 shares. What is the difference here? Your return on investment. How much money did you put? Just $300. How much money did you make? $2,100. The stock went up the same. How much is that? It was actually 7 times. In this example, numbers are arbitrary, okay? But you do make 7 times more. So what do people think? Wow, here is a product you wouldn't believe that you just pay $300 in this example, like a fixed amount. This is your maximum risk. You can't lose more. Like, because in the share situation, the 21,000 can go to zero and you will lose $21,000, right? I'm not saying how probable that is, but you will. But in this case, you only risk losing $300. Who in his right mind would not invest in something that it gives you a defined risk, $300, with a 7-time return on investment, and willing instead, you know, putting down 21,000? Many people. But you know what? This has an about 88% probability of losing money. Why? Because, my friends, options are wasting assets. Options, I'll write it here. Options are wasting assets. What does it mean? They lose value no matter what. As day goes by, like the song goes, options will lose value. Will lose value. So why is this losing money? Because options have another thing. You have to pick an expiration. It's not like the stock. You keep it open until you make money, because eventually Apple will go, I guess, 10% up like it did recently, right? But here, you have to choose an expiration. And the expiration is like the third Friday of the month. Typically, you've got more expirations, but it is the third Friday of the month. I will show all this with a live example later in the platform, okay? So you've got two things. You have to forecast correctly the movement upside, the move upside of Apple, but the hardest thing is just to say that Apple will do that within like 3 weeks. What's the third Friday of June? I think is on the 20th of June. So by the 20th of June, Apple has to rise 10%. But if it rises just 1 day later, you've lost all your money. That's why 88% of these positions will lose money 100%. You just lose your $300. But that's just exactly what retail investors do. They think they know options, and that's exactly what they do. And you know what I do? I just make them the favor to lose their money. I help them lose their money by selling them the dream. I tell them, if you want to buy that because you don't know how options work, I will sell you the dream. I will sell you the option. So I'm acting like the insurance company, like I was saying in my other seminar, like I collect premiums, and then if you've got 80% probability of losing all your money in that bet, because that's what you do, you're betting, I've got 88% probability that this money gets in my pocket and stays there, right? That's the idea. And why do we do that? Because options are wasting assets, okay? So let's see why. We'll just take some moment to erase all that. Why is that? So what does the theory say? So theory says, and it's like, you know, this model was created in 1973. You don't need to know the model, just like you don't need to know the car parts to be able to drive a car, okay? Now, this is one of the graphs that you really need to understand when trading options, perhaps one of the most important study with it. So you've got 120 days, 90 days, 60 days, 30 days, 0 days. This is like days to expiration, and this is like option. Okay? Now, what is the theory saying? The theory says that the time value, that's what you're seeing here, like, will not erode the same way if you've got 120 days into the life of option, or if you have 30 days into the life of option. And this is where the catch is. So what is it? If you start investing in an option today and you check the price of the third Friday, 4 months down the road, because that's what 120 days is, right? So say that's like we are in May, we pick the third Friday of September. And then as time goes by, you just move towards your 90 days. Like, so as of May today, the 14th, you're like now June the 14th. How did the option move? Well, let's see how did it fare. Just a little bit. You see? Let's put some color here. This is what you lost. Your option didn't lose a lot of premium. Why? It doesn't have so much impact. If you choose a 4-month option, your expiration date, because they have an expiration date, nothing really happens. Right. So say like now we are actually suddenly 14th of July. Here, you can see, let me draw it green. You are like, you know, you started feeling it, right? You've lost money, but you haven't lost that much money. it still hurts, but it doesn't hurt that much, right? And think like I've drawn that using my hand. It's not like I've got a millimeter paper. You would see the fall a little bit more pronounced. Now, the real party starts happening here. When you're actually going towards August, so remember that expires in September. When you're actually going towards August, you only have close to 30 days left. Look at that. Now, from this point to this point, you're actually down 40%. You see? And if you actually move towards 0 day, so like you're here and you're going towards September, you see the inclination is going parabolic. You're actually losing money very, very fast for having bought this option, only because days are passing. You see, if I stand here, your option actually has lost, what, 60%? Yeah, it has lost a lot. Okay? So that's the time value of money. That's because you've got days to expiration. And this is why I choose to trade within that time frame. Why, Yanis? Because you see that in that time frame, the acceleration in the loss of the time value is so big that it makes the people who bought the options without any protection, without any knowledge, lose their money 88% of the times. If they have 88% of the times losing trades, I have 88% of the times winning trades. Okay? So imagine the option now, you know, not every option will be the same, just to give you an idea to move on the positions. Like, think about, I mean, I'm Greek and I hope I don't have any Portuguese in the chat, but you know how it went in the Euro Championship. Like in 2004, Greece won the Euro Championship and Portugal was the first opponent and Portugal was the last opponent, right? So in a sudden stroke of fate, we thought like we could conquer the world in football. And the first match, the bookies, like they were thinking of Greece and like, Greece who? So they were betting that Greece would win the championship with 1 to 240 probability. So €1 would pay you 240 euros. Okay. And then my wife comes, this is like, you know, why don't you throw 50 euros? For that probability, it's like worth the risk. And I'm like, nah, we're going to have some beers and some nachos. And I'm like, you know, it's been 21 years, for God's sake. And she still reminds me that. Like, but anyway, so 1 to 240. Now, this guy was betting or forecasting that Greece would win the championship, right? So then Greece goes and wins all the matches until it goes to the final and then plays against Portugal again. And guess what? At that point, Greece is betting 1 to 1.4. So €1 was actually paying you only 1.4. So what does it mean? Both bets are actually betting Greece would win the championship, right? But the original bet was paying you a lot of money for taking a huge risk, but it will cost you just a little bit. This is called an out of the money option. Something that costs a little bit. It has very low probability of making you money, but if you do, you know, have your way around it, you will make a lot of money because you have to get compensated for the risk you took. This is called an out of the money option, and it's really worth it. And actually, the out of the money options, we lose like that, the time value. The other one is called in the money option. What is the other one? An option that you pay a lot of money because it gives you the probability that you will make money like 90%, but you can't make a lot of money. Why? Because it's very probable that you will. So high probability of making little money will cost you a lot. Low probability of making shitloads of money will cost you just a little bit. You see, that's the same idea in options. The in the money option, by the way, it's still here. What's this one? Well, this is what we call the at the money. What is the out of the money in the money? Well, the out of the money, like I said, I don't want to bear you with details about, you know, prices and exercise prices. Just think about probabilities. Out of the money, low probability, low cost, high payout. In the money, high probability, low payout, high cost. What's the at the money? Well, it sits right in the middle, spot on. Okay. So now that we've cleared everything, let me just go and show you why combining something that we call a short call, just yeah, with your shares is always better than just buying the share outright. Okay. So people keep entering the room. Thank you very much for this. So this is called a cover call. Yeah, this is called a cover. So you know by now, I like my graphs. And here we actually see graphs at expiration, like I say, right? Before, at expiration is where there is no time, right? Well, that curve has gone to zero. Before that, you can definitely make money. You can definitely close the position you opened. It's just, I need to show you something without the various variables going up and down, okay? And that's how people do it. This is your long stock position. So long Apple and at $210. That's how it shows. Okay. Zero, negative, positive axis. Okay. And all I'm saying is that 4 out of 5 times, like I said in the title of my webinar, you will be making more money, not only in this position, but in various other option positions by selling a call option, which you can draw it like that. It doesn't matter, you know, why I draw it, I know, but you will learn it if you decide to do so. Now, I sell something, right? So a cover call is long stock plus short call. That's why it's called a cover call, because it's covered by you know, holding the share. Okay. Now, listen, I'll just go ahead and delete that because I just wanted you to know why it's called cover call. Okay. Now, when you buy a share, that's fine. I hold shares. I hold shares for the medium and long term, right? And that thing here will actually help you make more money than just holding the share. So when you actually sell something, what do? Let's say we are making $2. Yeah, when you sell something, you actually make money, right? You charge for that. You take money, you don't pay. And that's why we depict it on the plus axis. Okay. So that will mean, and let me draw it with a red here. I like this little thing. That I'm always $2 better than you, and I will show you why. Using the call option. So you had the strike price. You bought Apple stock at 210. I bought Apple stock at 210. But because I sold here a call option right here for $2 at expiration, I will show you all the scenarios why I get to keep that call option and what happens when I don't get to keep in that only one situation. So let's take a look. This is strike price. I didn't put a strike price for this. So in order to get the $2, which is what? $200, right? We always multiply by 100. So I thought it would be nice to have this 225. Okay. So we sell a call option at 225. What does it mean? It means many things, but for you today, it means that as long as the price of Apple stays below 225, you will always have this amount, which is called the premium, in your pocket. Yeah. So as long as it stays below 225 by expiration, the price of Apple, I mean, you get to keep all the $200 or $2 per share, because one option, I'll remind you, is 100 shares. Okay. So say Apple goes up Yeah, so Apple up. And it goes to 219. Yeah, so what happens? You make money from holding the shares, right? You make $9 from holding the shares. I make money from holding the shares because we both own shares of Apple. Yeah. But what happens? Apple is below this 225 price. So I get to keep all my premium here. Yeah. Like I told you, selling a call option at 225 just means that you will make all of these $2 multiplied by 100, $200 per contract, as long as Apple is below 225. So 210 to 219, you made $9 from the share, I made $9 from the share, but I also made $2 from the call option. So one case, I made more money than you. Two, Apple stays the same, flat. So it stays at 210. Do you make money from the shares? No. Do I make money from the shares? No, but I do make money from the call option because it's still below the $225 that I set as my price. So there you are. Second scenario, I get to keep $2 more. This is why I drew this line, because that shows the line. I will always be by $2 better than you on the share. Three, Apple share falls, right? And it goes, say, to 208. You lose $2 from Apple share. I lose $2 from Apple share, but I made $2 from the option because Apple trades below 225. What does it mean? I'm break even here. You lose $2 per share. Fourth scenario, I could go on and say like Apple will fall more. You are always $2 worse than I am. Okay, so if Apple falls a lot, I still make more money than you. And what's the scenario that you really make more money than me? If Apple goes to the moon. So if Apple goes to, say, $262, for the sake of giving a number, what does it happen? It happens like you will be making money. You will be making money from the share. I will be making money from the share. But after the break even, I can't do it here because there's no space, but I will be losing money from the option. Now, what is that called? It's not called I'm going to face a loss. You know what is it called? It's called opportunity cost of capital. I could have held just Apple shares and I could have made more money when Apple rallied. So the fifth scenario is only a scenario where Apple from 210 skyrockets to 262, in other words, makes like 40% increase in just 40 days, which is the typical days to expiration that I choose. How often Apple does those things? I'll tell you, in 2.5 years, I've never seen it. It might have gone up by 15%, or it might have gone up by 20%, but it doesn't stay there. You know why? It's something that we call mean reversion, and I'm going to show you right now. So the question here would be like, yeah, it's okay, Apple, yeah, but Tesla, yeah, but don't do it on Tesla. You don't need to do it on stocks that go like crazy. Tesla, Netflix, Zim, I don't know, Alibaba until recently. There are plenty of stocks that you can do those things and some stocks that you should not. Why? Because they've got a high volatility level and it could go through your thresholds easily. You don't need to. Investing should be boring. It should be repetitive. Do, repeat, cleans, do, repeat, cleans. It should be something boring. If you want excitement, go to the casino, okay? So we're not talking about like, what is it called, the English word? Well, where is my English word? I need it the most. Anyway, we're talking about healthy speculation here, okay? So when I tell you that this works on Apple, it works on Microsoft too. It works on ABBV too, Abvia. It works on Walmart. It works on all the big companies. And by now, you've probably realized that I trade the US markets more than everything because, you can trade ETFs from other countries and so on. I do trade ETFs as well, by the way. So a cover call is a position where 4 out of 5 scenarios, I will make, or you can make more money by just selling a call option and not just owning your shares. I don't know how to pay. Ah, there you go. I can. No. Okay, I'll delete that again. Okay. And show you what the mean reversion is and why this is really based on that. You know, it's not simple, but it's easy. So I love technology, right? Just allow me while I. Okay. So what does it mean? Now, assets from A to B will not go in a straight line. Even if A to B is like in a bull market, you won't go. You know how it would go? It will go like that. Yeah. And what does that create? It creates, if I do it, this wave up, wave down, wave up, wave up, wave down, wave up, wave down, right? So you do get a mean reversion on shares. And why is this mean reversion true? Because they really don't know. Have you seen what Apple did lately? It went from 177 to 210 and then stayed there a few days, and then they will revert to their mean because that's what assets do. Now, if you bought like a Bitcoin Yanis, does it revert to its mean? Well, in a longer enough time span, it does. But then, you know, they rise and fall, rise and fall. And in the meantime, they just create a mean reversion. And then they just take to the next level, okay? Because of the mean reversion, and because that 75 to 80% of the times, traders and investors alike overestimate the risks in the market. And, you know, that's depicted in the volatility assigned on options and on stocks. You are better off selling volatility than buy. So like selling options than buying options. And why is mean reversion good for selling options? Because when you sell an option, say here, and your price goes here for like a week, it will go down and then up and down. And while it's doing that, your time value will erode, will go down. And like we said, this is very good for you. You're doing it like the insurance. And those big guys know better than us. I trust you know that. Like they take premiums from everyone else, and then occasionally they have to pay a crash or a theft, a burglary, etc. Same with the casino. If you go to the US, you know, you've got the roulette with a one green and a second green, which are both 1-0 and 0-0. Yeah. So the odds are against the player, because the casino, if you do the math, you know, it's not over the same number. You don't divide it by the same number. You've got 36 against 38. It's a 5.4 advantage for the casino, right? I'm not saying we're doing like at the casino, but the casino doesn't bet against the player. The casino actually wants the player to stay there. That's why they don't have windows. They don't have like clocks. And they have beautiful women serving fantastic food. Why? Because they want you to feel relaxed and continue, keep playing. Because if you keep playing, you will fall into this big number rule, which says like the longer you play, the casino will have 100% probability of making 5.4% for every million. So the casino will make $54,000, pounds, call it what you want, for every million traded. Why? Because they don't care if someone loses or makes money, or if someone like makes money like 10 times in a row, because other people will lose money. They will always have the statistical edge. That's what you want to get through options. The insurance has the statistical edge, because you've got those nice people, which we call them actuaries, and they will sit down and they will tell you, okay, what's the probability of having 50,000 cars crashing during the same month or the same year out of 1 million? I'll tell you, it's very small, right? So they take the risk. They collect the premiums and they handle the risk for this time that, you know, sometimes things or bad things happen, okay? Like when I said in my presentation, you've got the leptokurtosis bell-shaped distribution of S&P. This is like 60 years worth of data on the S&P 500. And that shows you that 1.5 days for every 5 years, you got a black swan event. And then I actually said, you know, how often corrections are. So how frequent corrections are, like a 10% correction every 2 years. So you don't really need to get panic when you see a correction, you actually need to see it regarded as an opportunity. Okay, so you've got a mean reversion here, and what you need to know is the bell-shaped distribution. Well, the normal one. What do you have? Well, you have me and you have the sigma. So me, this is the average mean, yeah? So the average means that, you know, in a bell-shaped distribution, the Gaussian distribution, as we call it, you got the mean, median, and mode, the same number, which is here, because it's all falling under the same distance here. Now, it doesn't matter what that means, because you don't know, in real market, you don't get that. You don't get a real time, like a bell-shaped distribution. It will be skewed, as we say. What does it mean skewed? Well, you might get that, or you might get that. Okay, so that's what skew means. But what it means here, what I want you to understand is that this is like sigma 1. Sigma 1 is like 68.7% of the time your asset will fluctuate within that range, right? The sigma, the standard deviation, that's what it means. Standard deviation, it actually gives you the risk from deviating from the mean, from here, okay? So if you choose strike prices at one standard deviation, it will give you 68.7% of the time a correct outcome, a positive outcome for you. And because assets will move from here and will go here, and because of the mean reversion, they will go out a little bit and then, oops, back in. That's why 68.7% of the times you choose the strike prices this way, because you will make money, and sometimes other factors will make you actually 75, 80% of the times. That's why my hit rate sits around 82% of the times. So I make 82%, 82 trades out of 100 correct trades. So I've got the statistics on my side. Why? Because what I just showed you, I will show you a couple of examples. Okay. So for you to remember now, summing up a little bit, is that we don't trade because we think that the market is going somewhere. I actually don't know, like anybody else, where the market is going. I can only guess, right? It's guesstimate. So I trade statistically, just like the casino and the insurance. Make €1 every day. Don't go for the lottery, because if you go for the lottery, there is a better place to do that. Okay, and what does it mean €1 every day? Like, I need you to make money while you're sleeping, literally, because the position I'm making, like, they go like 2, 3, perhaps 4 weeks sometimes open, and then I'm taking like 50% of the money, or depending on the strategy. Yeah, it's not like day trading or scalping that we're doing here, because like I said, life is what happens while you're busy doing other things, and I don't want life to see it going by. And me in my 70s, with a lot of money in my bank account and very little experience to share with my kids. I'm sure you will understand. Even if you are young, that's a life lesson which I learned like growing up. I'm 52, by the way, now. So if you choose your strike price, like the level of, triggering your option at one standard deviation, which you can calculate it, but you don't need to learn that today, it will give you 68% of the times the certainty that you will make money. Because of the mean reversion, things will go in and out of the curve, and you will achieve that. If you go 2 standard deviations, sigma 2, that will mean that you have a 95% that this thing either going up or down, you will make money within that range. Yeah, but what happens here? Well, you're not going to make a lot of money because of the same principle. Something that has a very high certainty of taking place, it won't pay you that much. Okay, so two things you need to remember today. The mean reversion in financial assets is there for you to take advantage. The statistical noise between hours or days or perhaps weeks will always settle down, and it will make you actually make money within that range here, the 68%. And the way we choose the strike prices for our options is like both an art and a science. Okay, so it's not like I think Nvidia is going up. If I think that, I buy the stock. But if I buy the stock and I need to do something with options, I don't use the graph. to say, oh, Nvidia is going up. The options chain, which is what we use, gives me all the information about what traders are projecting now. And like I said, more often than not, 75 or 80% of the times, traders and investors alike will overestimate the risks in the market. And that's why you see markets turning at the lowest points. That's what it did 3 weeks ago or 2 weeks ago at 4,850 plus something. That's what it did at the COVID bottom. That's what it did at 2,175, which was the COVID, by the way. Okay, 2022, the history repeats. By the way, there is a fantastic book that tells you this time is different. It's called by Kenneth Rogoff, and Reinhardt is a lady. I don't remember the first name. And it's called 800 Years of Financial Folly. This time is different. You need to know the bigger picture, the perspective of the macroeconomy to understand that when there is an unsustainable debt, like in the US, eventually, if you cannot pay that, and if you are actually protecting your country by putting or applying tariffs, then there will be no competitive companies anymore. Apple will not have an incentive to beat Samsung because Samsung cannot sell the products into the US. That would make the US companies not competitive enough. That will make inflation. The Fed will likely increase rates to battle inflation. That will create unemployment, and that will in turn create a banking crisis, which will lead in financial crisis or a debt crisis. Yeah, that's what happened in 1929. That's what happened in Greece in 2010, and that's what happened in pretty much every bloody crisis in the world so far. Okay, so that's a very good book for you to read, and as a reminder. But in the meantime, we actually invest because while the euro or the dollar depreciates, the markets are doomed to go up, albeit, with a lot of volatility in between. Okay, so mean reversion, standard deviation, 68% of the times, that's how you choose your strike price. It's all a science and an art behind it, no guessing. So that takes me to my other example. So let's see what our friend Warren Buffett did during his career, which, by the way, he blamed or spoke about options in a very bad, shame on him, in very bad words. He called them weapons of mass destruction for the Lehman Brothers, yeah? But he was the biggest player or the biggest investor using options, trust me. What was he doing? So he was actually selling put options. Okay. Now, first and foremost, options were actually created to protect the farmers, protect the crop from natural disasters. Yeah. So when you buy a put option, it means like you're buying an insurance on your car, on your house, or whatever that is. Yeah. So buying a put option means that you are expecting something to fall and you want to protect yourself, much like the insurance you're buying. But if I'm selling you that, it means, again, different aspects of like betting on people's, wrong estimation of volatility and all the things that I've just said. So what does that look like? Listen, selling a put option, it means like if Apple trades at 210 today now, I actually want to buy Apple at 185. Yeah, and seriously, this is what Warren Buffett was doing in a different way. That's how a short put option looks like. Okay, now you're selling again, right? And say that 185 put option that you sold, it doesn't cost to you, but it has a price of $2. Yeah, say it's $2. So you pick $2, which is like $200, because one option is equal to 100 shares. Okay, so you actually get $200 at the beginning, and then you wait until the end of the contract, like the third Friday that you chose. For me, 40 to 45 days out in time, for reasons I've explained at the beginning. You will see the recording for those latecomers, and you actually wait for this to sit in your pocket. So what was Warren doing? And, I've been doing, and everybody who knows option is doing. Like you are selling put options, but there are two cases here. See here, it's a naked put option. Why do I call it naked? I call it naked because I don't have the money. If I don't have the money and I'm selling a put option, I'll tell you what it happens. So let's take a look at the scenarios here. Now, when do I sell a put option? I sell a put option when I want to get these $2 or $200 on a stock that I think it will have like a moderately stable or bullish. Yeah, I don't want to buy Apple now because Apple has rallied, say, like $30. And I don't know what Trump will do tomorrow, but I really like Apple. I don't have the money for now. So what do? I go one standard deviation away from the current price. That will be around 185, 190, depending on what we call the stickiness of volatility. So because people assign different perceptions on a given option in a stock, that option will be more expensive or less expensive. That's what the stickiness of volatility means, actually. Yeah. But one standard deviation will be around the 185 strike price. So what do I have here? 68% probability that I will keep these $200. Yeah, that's $200. 2 by 100. That's what it means, right? That's what I just showed. Okay. Why? Well, first scenario. Apple goes to 230. Yeah, here. Happy days. I keep my money. Why? Well, you can see here that I lose money only when Apple falls to that place. So as long as Apple trades above the 85, the strike price, I will always keep my $200. Yeah, that's why this line is capped. That's why this line is solid. So if Apple goes up, I keep my $200. So one scenario, I make money. If Apple stays at same 210, guess what? I keep my $200. Why? I don't own Apple, right? I don't want to own Apple. But I keep my $200 because Apple stayed the same. Even if Apple falls by 10 or 12%, so Apple down by 10% or more, guess what? Magic. I still make my $200. Why? Supposedly, it hasn't crossed the 185 level. Where on earth have you seen a product that makes you money when it goes up, when it goes down, or when it stays stable? Where? Nowhere. It's only options. So why? Because I've chosen the one standard deviation. It gives me a 10% down move. And when Apple falls 10%, it will succumb to the mean reversion. Apple cannot fall 30% unless we are in a bear territory, and I will discuss that now. That's my fourth scenario here. What happens if Apple falls 20%? Well, that will mean that you move towards here and boom, you enter into the negative territory. So this is where you can lose what I say undefined. And that's what scares people off, the undefined risk. But there is mean reversion. So when I tell you that 85% of the times stocks will actually follow the mean reversion rule and they will go back into their prices that they were before, if Apple forms from 210 to 185, that will mean that about, 3-4 weeks have passed. So if we're not in a bear market, even with Trump tariffs, all that happened is a full month of March. Apple fell from 230, 220 to 175, and now back to 210, and it has done that within a period of 5 or 6 weeks tops. Yeah, I trade with about 4 to 5 weeks time, days to expiration. So even if I didn't move, I'm still making money because Apple went back into my range. Now, the risk here is obviously if Apple continues to fall, I have to use risk mechanics. And what I use? Well, the first thing is because risk management is really important. So what do? If you don't have the money, yeah, and Apple has made a down move for like 3 or 4 weeks and it's gone like 12, 15% down, the first thing you do, so risk management here, risk management. The first thing you do is what? Is roll time. So what would you do? You will take this option here. Let me just draw it. You will take this option here as a put option. And instead of like the 20th of June, you will roll it to whatever third Friday, let's say is the 20th of July. What does that give you? It gives you time. It gives you time. What does it mean? That Apple might fall another 5%. But like I say, if you are not in a bear market that you haven't got, your head around, Apple mean reversion, you allow the stock to go back above your strike price. Now Apple continues to fall, like for a couple of weeks, it doesn't really want to go up and it oscillates around here or around here. So what do I do next? Second, I roll down the strike. What does it mean? Well, listen, the 185, I just go ahead and sell the 175 put option now. And if Apple continues to fall, well, listen, I have to put a stop loss at 3% below that last strike price. And the strike price is we call it X. Okay. Now, is it risky? Yes, it is risky if Apple goes indeed into a bear market. What we just felt the last month is not a bear market. It was a nice correction for whatever exogenous shock that really proved very short-lived. Within 4 weeks, we got €1,000 rebound. And that's what happens. That's the mean reversion. But here, I'm talking about the worst case scenario, which you should know. Okay? How do you avoid that? What is it that Buffett does? Well, let me just delete a few things here. What Buffett does is do it as a cash secured. In other words, cash secured put option. What does it mean? Well, you got the money to support the stock. Why is it nice? I'll tell you now, you will flip out. So, come on, technology, be with me. Okay, so what does it mean? If you got the money, that's what it means, cash secured. For every one option that you sold on Apple, you need to have how much? You need to have $18,500. Why? Because one option equals 100 shares, right? So you need to have $18,000. Some might say, Yanis, I don't have that much money, so you will be going into the first option if you want. But the cash secured put position and what has made really that old man with the glasses make a fortune is like saying, listen, the mean reversion and the standard deviation, the statistics behind all that tells me that on good stocks like Coca-Cola, Apple, Microsoft, Wells Fargo, the stuff that he liked, they don't really move like crazy. They're stable stocks, paying dividends and all that. So what happens? If indeed Apple falls and goes into this negative territory, what does it mean? I will have to buy Apple shares here, trading, say, 175. Yeah. I buy Apple, but not at 175. Where do I need to buy? I'm obliged to buy them at 185. That's what the strike price means. So when you sell a put option at 185, when Apple trades at 175 after like 4 or 5 weeks, you just buy the stocks, but obviously you buy them at the price of 185. And what happens there? Well, because of mean reversion and because Apple has been falling for 5 weeks, what does it do? It starts climbing a little bit, climbing, like it did now. And what do? You start selling call options, like in the example before. So you bought Apple, and then you have the call option. So what do? Apple will not go, just like stocks, don't go from A to B in a straight line. Apple will not go up $50 in a week. Apple might go up $50 in 2 months. So what do? You just start selling call options every month. You collect $2 one month, $2 the other month, And by the time Apple actually goes here, I'm sorry, there's a lot of drawing, goes here, you have made money from the stock from 175 to say 195, and you have made money from, say, at least 2 rounds of sold calls, like 2 times by $200, and that while Apple has fallen by more than 15%. Now, isn't that a beauty? And I just like with these examples, and I will give you one more, and then, talk a little bit about my offer for you today. It's like 1 hour that this webinar has gone. So I want you to change your mind from a binary mentality. Binary mentality means you buy a stock, you pray that it goes up. If it goes down, you blame your stockbroker, your mother, your mother-in-law, your friend, the newspaper, but never yourself, I guess, right? I'm sorry to be so harsh on you, but that's what we normally do. We don't self-flagellate ourselves. That's how the human mind is constructed. So there's a lot of psychology behind all that, but this is not the time to talk about psychology. But if you start trading options or investing with options, you can actually make the market pay for waiting for a stock to be bought. It's like putting a limit order, right? What did I do before? I say, when Apple is here at 210, you actually sell a put option to buy Apple at 185. Isn't that like a limit buy order? You're placing a limit buy. But when you place a limit buy, the market will not pay you. The options will. How much? $2 in my example, equal to $200. Yeah? That's the difference. You get paid for waiting to buy a share. And if you don't buy the share, you collect a premium. That's the beauty of options. You sell a call option while you were losing money, and at the end, you make double the money because options allow you to take advantage of market statistics and people's folly. Okay? Now, last but not least, let's see an example, which is called, funny names they choose, right? A bull put spread. Okay? So what is a bull put spread? Was more or less starting from the idea that we just said. But in the cases that you don't have the money, so listen, I don't have $18,000 to support Apple. I respect that. So while Apple is trading at 2010, I will sell that put option at 185, like we did before, right? But now I will buy my protection. So remember what I learned at Citi? So by the way, I spent 9 years at Citi in London. So, Canary Wharf, second floor. The more important you are in these type of environments, the lower floor you occupy, because if something happens, you need to be able to get the bloody out of there. So there were 943 places of work in that same floor, in this 45,000 building, right, in Canary Wharf. So 930 or 940 plus is like, I was doing structured options for hedge funds. Yeah. Somebody else was doing rates. Somebody else was doing, stocks, ISAs, foreign exchange, you name it. And the guys in the center, they will call the automated trading team. And what they will tell you is like what I told you before. When you buy something, you have to sell something. Like Citi, when actually an order came in for a swap of 10 million, you would have to do spot exchange 50%. What does it mean? You just do the opposite for 5 million because you can't leave that risk unhedged. So that's what we do. We take the philosophy and the knowledge of the big, the G7, the Seven Sisters, and I've applied it into my options seminar and knowledge and trading, which I'm sharing now with you. Okay, so it's not like we know where the market is going. We know the mechanics behind it. We know the mechanics, the statistics that give us the edge, just like insurance and casino. All right. And by the way, I've written a book in Greek. I hope I translate it in English. It's called Invest Now, You Thank Me Later, because of the merits of life. You don't need to know the timing of your buying. You just need to spend time in the market. And this is like a good thing, just to make a parenthesis. For my magazine, I've interviewed Mark Mobius. Mark Mobius used to be the Templeton's, one of the biggest managers in the world. And he was running like 40 billion or something of like 20 years ago, that is, of an emerging markets fund, right? So when I asked him in the interview, and like I said, I can send you the interviews in Greek, and I have some of these interviews in Spanish, like Tom Sosnov, who trades options, and he had Think or Swim, which he sold to Ameritrade, and he then went on to create another platform, which is I don't remember now what it's called, but anyway, lots of great interviews there. And then Mark Morris, when I asked him, like, listen, our readers would like to know when is the good time or the best time to buy. You know what he answered? When you have the money. He didn't tell me RSI, he didn't tell me Zweig, indicators, thrust, AD declines, nothing of this sort. When you have the money. Because when you have the money, you just stay invested, have the statistics on your side, use options short term to hedge your risk, make the money pay for taking the risks, and let other people have, you know, the dream of getting the lottery, which, as you know, this doesn't always go well. So for that reason, I buy a put option, say 170. I go then one standard deviation lower, and I buy a put option. And what does that mean? Well, that will actually mean that if you draw it. Okay? So let me just delete that part. I know. Anyway, it was like that. Okay? So I want you to see that all I did here was to buy protection. I think like when the market sits at 210, I didn't want to buy the stock, but I wanted to make money by selling something. So I sold something for, you know, the regular $2 that we've been doing, right? I sold this put option for $2. But then I bought this put option, so that's minus for like $1. Yeah, because when I buy something, I pay. You see it on the negative axis. When I sell something, I receive money. But here, the net investment is like $1. Yeah, is the difference. You treat it as a spread. It's called bull put spread. It's a debit spread. You pay money for that, okay? And no, sorry, you don't pay money. You actually get money because you get $2 and you pay $1. So it's a credit spread, okay? You get money in your pocket at the end. So same logic as before. When market goes up, say here, you get to keep all the money. Why? Because as long as, like before, Apple stays above 185, you get to keep all the premium. How much is all the premium? It's not 2, it's 1. Why? Because you took a protection for some good reason. Yeah, if market stays stable, same as before, you make all the premium, $1. If market falls by 10%, you make all the premium to 185. Why? Because the stock still trades above 185. Where is your risk? Well, your risk is here, right? This is your option premium being eaten out. You're still on the positive axis. Here is your break even because that's where you're actually going into then negative. And that's the way I've drawn it, your negative area. Okay, here. Is actually here, yeah? That triangle. This is your maximum loss. So what happens here? This is a fantastic thing because why? Because you've got a risk-reward ratio of 1 to 13. This is bad, but you've got 87% probability of making money. Yeah, I'll just show that on IB to finish this off. You've got a bad risk-reward ratio. Why? Because if you collect $1, then the difference here will be roughly $10 that you're going to lose. So nobody in his right mind will leave this position open until the end. So what do? Same strategy as before. Risk management, my friends. First of all, roll in time. This will go to July. Second, roll strike. This will go to a bit lower. So you don't really face never 1 to 13, but when you do make money, you have statistics on your side. That's 87% of the time. It's called bull put spread because you want the market to go up but not that much. Why? Because you will have opportunity cost of capital, as I said, if the market goes crazy. If Apple goes to 300, you would like to have held some position that actually, it makes more money when Apple goes up. Okay, so these are just three positions, three examples for you to understand how options really affect your portfolio in a good way, because they can make you money. They can make you money when things go up, when things are stable, when things go down, and they can make you money in very diverse ways. The best way, the best reason is like the risk-reward ratio they have is superior to actually taking risks in a different way. Okay, so let me stop sharing this screen and then share my platform. Okay, this is Interactive Brokers platform, right? And this is one of the portfolios I use to showcase everything. So what is it? So in this 108,000 portfolio, yeah, there is cash, which is $5,000 cash here. You can see that. So it's all invested. Obviously, it's, a big part of it, like less than half is in a sovereign English bond. It skews a little bit things, but you can tell. So Apple, let me just move my here. If I type Apple here, I choose Apple, okay? And then you see everything changes, the graph of Apple and so on, all right? So what do? I choose the expiration first. Where is the expiration? The regular is like the third week of the month. Well, regular, June, 20th of June. That's 37 days for expiration. What do? I click here, strategy builder. I want to do a bull put spread now. So for you to understand what is it live. So I'll bring that down. I can choose here. You see the strategies, all with the different names. You don't really need to know the names, but at the end of the day, you would need to be able to understand these things and structure it yourself. But what do we say? Where is Apple? 211. So let's say it's at 200. These are the strikes, okay? 210. You see, here are the call options, and here are the put options. You really don't need to understand everything now. Just understand that call options go up when the market goes up, put options go down when the markets go down, go up when the market goes down. That's your insurance, okay? So if I sell a put option, see what IB does. If I hover my mouse, it will tell you the standard deviation. I calculated because I know how to, but if you're lazy, this is what it's doing. Between 195, 190, you get one standard deviation. The reason I wrote 185 is because I didn't have the screen in front of me. So Apple is, has a higher, juicier premiums, because remember that people will always be afraid of losing money, not making money. So what is it? What it means is that you would actually be prone in buying protection rather than buying positions that will make you money. That's why you make put options more expensive than they should be. And that's what the stickiness of volatility means. Yeah. And that's because after 1987, the big crash, where S&P fell like 22% in just a month or a few days, and then it reversed. Remember mean reversion? Like, this is when people actually realize, hey, I need to be able to hedge myself. You didn't have internet at the time, and you didn't have all the resources that you have today at the touch of a button. But, gradually people understood that, I need to hedge myself. You need to hedge yourself for falls against, like for stocks, ETFs, and indices. But you will need to hedge yourself against a rise when it comes to what? Oil, wheat. Because if wheat goes more expensive, you're not going to have the means to eat. And if oil goes up, you're just going to have to put up with not driving, traveling, and perhaps even other essential needs. Okay? So say 1 points to down, say we choose that, 195. So I click here, I click on the bid, because this is where people buy, 195, yeah? I click, it doesn't execute anything. I just click on that. And then I go another standard deviation, So 2 standard deviations, and here 175. I got that correct. And I buy that because that's my protection. It doesn't do anything. I just put this here. It gives me my profile. You see, I click on profile, and that's the graph. Look at that. I didn't know. I just picked, Apple and arbitrarily chose the strike prices. Look at that. 86%, 86%, I repeat, 86% profit probability. How much you will make? 156. How much you will lose? 1.8 thousand. 11 or 12 times more. That I knew. Always in these positions, the way you choose the strike prices in a 1 standard deviation, you will get a risk reward ratio of 1 to 13. You don't leave that. You manage it the way I explained, but you got 86% that this won't happen. Why? Because financial assets are mean reverting, and because you allow the stock to fall 10% and still make money because of the 1 standard deviation and some other things that we really don't have time to go through today, but I'm sure you get the idea, right? So that's the pull put that we saw, 86%, and the way the platform shows you that, okay? This here is the implied volatility. This is what traders think the market will do. It doesn't really matter for now, but you see, when I actually make a trade on this, let me just clear that. I would go and say, listen, first of all, how do I know something is more expensive than it should be? Well, in Interactive Brokers, in my watch list, I've created look at that. Historic volatility close, implied volatility. The historical volatility is just a mean, the average mean. They take the volatilities of 1 month divided by 30, right? The implied volatility is what traders assign on that stock. So if you see numbers here that are actually above 100, which now they aren't, these are candidates for you to sell volatility because it means things are more expensive than they should. Now is not the case. So that gives you an idea what you would do in those tickers, okay? Some of them are ETFs, some of them are shares, all right? So you have the ability using this platform to do whatever you want. And for year to date, what I shared in my talk the other day, this is my portfolio, this is performance. As I stand today, I'm up 10.31%. There you are. Nasdaq is down 133. You see, since inception, I'm overperforming Nasdaq using options because otherwise you can't. And just a few days ago, that overperformance was even more. That's like an 11% overperformance. Here is more like 14%, or here is 16%. So consistently overperforming the market by using the strategies I just mentioned you. And obviously, there are many more strategies that options help you actually make this overperformance. Now, what I aim at is use strategies for that passive income that we all want. How do we achieve passive income? We achieve passive income because we know mean reversion and standard deviation will actually put things into perspective for us to make money, even if things go the other way for a short period of time. Okay, so you can have your passive income. And this is it's a marathon. You don't expect to be rich within 2 months. Don't do that. €1, remember, every single day. Okay, don't be like the others. Like I say in my landing page, which I'll show you now, and then I can take your questions. 90% of the times of new traders lose 90% of their money in just 90 days. Why? Because they do exactly the opposite of what I just showed you. So if you've got 90% of the people doing what loses the money, you are able to do the opposite and make money 90% of the time. Okay? It's not magic. You don't need to be a math whiz. You don't need to be a graduate of MIT. I didn't show you here a single piece of formula. I just showed you logic and to understand how options are structured. Okay? Now, before I go to your questions, I'm sure you would like to know a little bit about the offer that I could give you tonight. Now let me share my what do I want to share? Let me see. Yes, I want to share that one. And before that, this is my YouTube channel. Now, obviously, it's, you know, Spanish and Greek, not yet in English. I'm sure, you know, they can translate things for you, but just so you understand, you know, who I am. As I told you, I speak Spanish, Greek, English, Italian, Russian, and so on. But here I've got these 3 languages, and I talk about, you know, this, like, there's 6,000 views here. I'm talking about Trump and tariffs and why I think markets will go up. That was like 3 weeks ago, and the markets did indeed go up, and that's why we overperform. And you can see, you know, various testimonials from people who have done my seminar, and you can see here some of the ideas that I share with you today. You can go ahead and check my Instagram. I just published my new book. This is called Like Invest Now, You Thank Me Later, in Greek. For my book presentation, I'm going to be in Athens in 2 weeks presenting my book. And this is you know, it's a bigger account. And people from Latin America also follow me here, and so on. And there's my landing page. So that's Master Your Options. This is the page where you can actually get to know me and choose. If you want to educate yourself with me, I'll show you for 3 minutes, and I'll tell you what the offer is. Having come from Daniel's event, which I had the honor to present together with, you know, Rob Kiyosaki and other people equally interesting. So Master Your Options. I'm too young here, so disregard these photos. I'm actually now here, so you know, no Adobe Acrobat techniques here. But anyway, you can flick through and a little bit why you should do this seminar with me. This is from a presentation, like I said, that I did in Panama, and you know, enroll for Trading Mastery Seminar today. So when you click on here on masteryouroptions.com, you get 2 things. You either start with the big seminar with my mentoring. I'll show you now. It's called Transform Your Financial Plan Now, or you just want to put it off. But remember, you say tomorrow, and within that little putting off word, there is a great risk of never being your reality. But if you want to take your baby steps for now, that will lead you into my landing page. You get to know me a little bit better, and you get, you know, some testimonials from people. And that's me. That's a photo actually 2 years ago taken in the London Finance Magnates. I get to speak there every November in London, and I do panel moderations. You can see all those in my YouTube channel. And what you would do is this, because of Daniel, typically costs 1,000 euros. You get a 40% off at 647 for a one-off payment. And this will actually be a 4-hour training. Some of the stuff that I've mentioned today will be mentioned, and you know, it will take you by your hand. And within these 4 hours, I will show you again with the platform that I use, more strategies, and go into more details. Send you 2 trading books, like EPDFs, like say here, and I will share my exclusive trading playbook, which I use to monitor my positions. Like, you will have lifetime access to course and materials. We won't go into too much details, of course. I've put a price here if you really want to get to know me, and before you take the leap, which I strongly suggest that you do today because of the discount and because of many things that I will tell you now. But these 4 hours will take you through the macroeconomic environment, will explain you the beta factor, the correlation coefficient, how we use to make a diversified portfolio, and why is it very good for you to know history and how history repeats. And obviously, I will go into detail with payoffs for the main option strategies, which is the long put and the long call, the short call and the short put, and a couple of spreads and volatility aspects that complement that. It's a really, really nice program. You get much more than what you pay. And because of Daniel's event, that comes with a 40% discount. But the beauty lies in, obviously, the other part, the transform the financial plan now part. Yeah. Why? Well, I've got a copywriting here, nice, humoristic aspect of why you should do things with me. And you got different photos for my media and, Spanish and English and Bulgarian and Bloomberg events and all that. And with a little bit of humor, because what life would be without the humor? If you want passive income, if you want to invest in the US and things like that, I'm explaining here what my flagship seminar on options has. And here are like frequently asked questions. So I'll jump straight at the end to tell you that this seminar costs 3,297 euros for Daniel. That seminar typically costs 5,000 euros, right? Why? Because with that, you get the seminar and you get 2 months with me mentoring all the way to your financial freedom, to borrow the, the event's name. So what it is, this is a seminar, 17 hours. So 17 hours, I will take you by hand, go through whatever the 4-hour seminar has, and teach you from zero what options are and all the nitty-gritty with live trading, live examples, show you what other students of mine have been doing, why they have been securing this, financial freedom that we all want, how to be away from the screens, because like I said, I've got 3 kids and I've got, no intention of sticking to a screen 5 hours a day. This will give you an idea how to make money, as I say, while you're sleeping, because we go through at least 20 strategies from the 56 in total that options offer you, only for you to understand that the way you start to combine the positions between calls and puts and selling them and buying them and understanding really deeply what this is, you really feel like, I can make money when markets fall. I see an opportunity when markets fall. I can make money when markets rise, and I can make money because of statistics, not because I can forecast where market is going. We're not forecasting. So you get 17 hours in a webinar that I will do live in about 3 weeks from now. So when you go in here, you want to pay for that, that seminar will be live. After that, people will watch the recordings. Like, you will have access to the recordings for a life. They will be on my CRM system, on my cloud with a password. You will have access for a lifetime. Once you watch the videos twice, because you will only be able to grasp everything if you watch the videos twice, I'm here to help you on a one-to-one consultation, as it says here, to help you dominate every single word of the seminar. I want you to learn the seminar and understand it, okay? And then once the seminar is done and you have taken your time to watch it, and then you can go back, review it, and have the recordings for you, I will sit with you personally, one by one, one-to-one, and do a portfolio creation or restructuring of your existing portfolio. So we will sit down, talk about your risk, find out what you really want to achieve, what your mistakes have been so far, and we will make that dynamic to make sure that we create a portfolio using shares and options that really match your risk profile. Together with that, I will give you 2-month access to my mentoring. So that will mean that you will be on my list to receive the same trading ideas that I use to make this passive income and the overperformance that you just saw like a few minutes earlier. Okay, you will get the 2 powerful trading ebooks. One is just a Livermore's, the reminiscence of a trading operator, no single formula in there, all financial psychology lessons that you need in your life. And then another book by Auguste Lebron, who teaches you how the stock markets are structured. And you've got a little bit of jargon in there. I'm always on your side to tell you what everything means. Last but not least, you will get a professional trading journal that I say here, which will help you take notes of all just your positions, because you're here to learn. Like, if I disappear from your life suddenly in a year from now, you should be able to actually replicate what I will teach you in this seminar and what you will learn from me in these 2 months of mentoring. Yeah. So you will actually be able to monitor the way I used to do it at Citi for, like, you can imagine, like 7 or 8 figures, and the same things that we use. How do I get in? Why did I get in? What did option did? How is my margin? What is my return on investment? Everything documented, because you need to document it. If you don't document it, you're just a person with an opinion, and it doesn't matter. You need data. Okay, all that comes for one in a life, once or one-off payment, because you just don't need any other seminar. If a seminar doesn't help you transform your life, it's not good for you. I won't have done my job well. And I think this seminar, from the thousands of people that I help in all these different continents and languages, you can watch, like I said, on my YouTube, various testimonials. This seminar is tailor-made to take you from where you are today to a better place tomorrow, without being on the screen, enjoying really what life has to offer. It's not easy. Okay, it's not easy, but it's not either very difficult for you, because if you understand the mechanics, it's all about practice. You will be able to have this practice with me for 2 months, and I'm giving you that together in that price. And that's why I really think that this option is really better for you. So you can use my masteryouroptions.com. This is my webpage to go through these. I will send you the recordings of today's sessions. It will be available for you to grasp all these ideas and find out what product of these two suits you best. And now is the time to stop sharing the screen, switch on your microphones, and ask me any questions that you like. Don't be ashamed. Are there any questions I can answer? Because now's the time to do them.
Hello.
Hello, Jordan.
Yeah, my name is Jordan for the next. I'm from neighboring Bulgaria.
Okay.
Do I understand correctly that you need to have at least the amount of money to buy 100 shares from any company in order to use the options?
No, that's wrong, Jordan. Why is it wrong? Because, like I said, you've got the option to use money to buy that because it's more secure for you. But the majority of my clients don't, right? And even if you have $18,000, you wouldn't spend all that to buy just one share. So thank you, Alexander. So what it means is, like, you are taking a different risk by not having the money, but you have ways of mitigating that risk, as I said, by buying other things, by buying your protection and so on. So the majority of people have anything between 5 and 20,000 euros, dollars, whatever. That's the average person investing. So with that, you can actually make the most out of options. Remember that you are still learning through this learning curve, but also making money. It will be easier if you've got 20K to make money than if you have 5K, of course, because this is all based on a leverage. It's all based on a margin, right? So the less money you have, you'll still be able to do the same positions, but they will be smaller. But the degree of responsiveness of your portfolio will also be smaller. But it doesn't mean that you need to have the money. That was just one example. The majority of the examples, you don't actually need to have the money, because we use options to leverage what the market statistics give us in terms of edge, and to make money while others actually pray for stocks to go up. So the definite answer is, you can trade options and use it for portfolios, even if it is 5. I have students in their 18s or 19s, and they have 2,000 euros, and they buy my seminar because they buy it for life. These people actually use it to learn, but they will leverage this knowledge for the rest of their lives. I hope I've answered that.
Yes,
Anything
thank
else?
you.
No worries. Anyone else? Just shoot it, because now's the time to do it. I've got a WhatsApp number when you can shoot questions, and it's on my webpage that I just showed you. Let me just put it here on the chat again. So it's masteryouroptions.com. It's very easy to remember. So you can find ways to contact me. But I will allow another minute or two now. And if you have any questions, I'm happy to answer. No?
Okay, I'll ask another question if nobody else wants to.
Yeah.
As far as I know, you have to pass certain tests on interactive brokers because this is the platform that you're using. So if
Yeah.
you're not allowed, I mean, if you're not,
Yeah.
um,
Okay. That's a very good question, Jordan.
yeah,
What I didn't mention is that I will open, if you want me, the account for you. So I will help you open the account. I will answer the questions for you because yes, the questioner there requires knowledge. And obviously you would imagine that I know the answers. So, you know, I help all my clients open the account. It takes me about 9 minutes and you get through the test, you get your interactive brokers account and you're good to go. So I'm able to do that within that,
okay,
relation that
okay,
we can
okay.
have.
Thank you, thank you.
All right then. So that was a very good question. Thank you very much, Jordan. I'll leave you now. Thank you very much for joining. I'll send you the recording and then I'll follow up in a couple of days if I don't hear from you. And remember, I will do that seminar live for those who will come here. You get a 40% discount from the 5,000 euro original cost to the 3,297 if you buy it now. Because of Daniel's event, I have to give you something for being loyal. And I hope to hear from you soon. Thank you very much and enjoy the rest of the day. Thank you,
Yeah, thank
Thomas.
you.
Bye, everyone.
Bye.
Thank you for watching.